Investors, welcome back to another go-round of Masters of the Market. Now, joining me for today's episode is Adriano from Passive Income Investing, a true passive income investor who has literally gone from zero to over $1 million on his investing journey to retire early. But here to share that story with all of us is Adriano himself. So let's get right to it. I want to pass the first question right over to you and just ask you about your story and how exactly you got to where you are today.
Yeah. So thanks for having me on, by the way, Ari. I like what you're doing. So thanks for the honor of being with you today. So the story, I mean, where do I even start? I mean, I'm assuming obviously you're talking about my investing journey, my investing stories. At the beginning, I didn't really know, like most people, what the heck I was doing. You know, obviously, I'd be completely honest with you. So at the beginning, I would say I was more of a swing trader. Now that I know the difference between trading, swing trading, investing, completely different things. And I'm sure we could talk about this later. I mean, it's a lot of people mess up not knowing the differences between those categories at the beginning. So trading, swing trading, that's not investing. But that's how I really started. I started about 2011, 2012, something like that. And I'm Canadian, right? So, now I live in Panama, but I'm a Canadian at heart. So typically I started investing pretty much 100% and still mostly do on the Canadian stock market on the Toronto Stock Exchange. So just really trying to flip stocks, just finding things that were in the news that were making a splash that I felt maybe crashed or I could make a quick flip on. So I started with, well-known Canadian companies that had a lot of trading volume, and I would just buy them and I would say, oh, we'll see what happens. I was just putting very, very, very small amounts. I wasn't doing anything crazy. I actually focused for the first couple, 5 years, 5 to 7 years, I would say, of my wife and I. We worked in technology, right? We weren't in finances whatsoever. We both worked in the technology field, but we always had some disposable income. So I used a little bit of that to play around in the stock market. I was betting on stocks like Bombardier, plane manufacturer. You probably know Air Canada. Some smaller energy companies, which there's a lot of energy stocks in Canada because Canada is a very, resource-based economy. So lots and lots of energy stocks. I wouldn't say penny stocks, but close to it. But more well-known companies, a BlackBerry, right, that turned into research in motion, or was the opposite. I can't remember. So that kind of stuff. And throughout time and during that period, we were really focusing our disposable income on paying down our mortgage. So, I've explained this story a million times on different platforms. It's not really an interesting story, but I wasn't comfortable to the point of putting a lot of money in doing this kind of strategy, right? It's trading is very risky, swing trading. I didn't really know what investing was at all at that point yet. So we put most of our money, which was a good decision. It's something you could never go wrong, right? Paying down your mortgage or throwing your money at mortgage and just playing around with a little bit with the stock market between, like, I would say 2011, 2012 to 2015, 16. And it was just a consistent cycle of just chasing whatever's hot. There was those stocks I mentioned at the beginning. Then the cannabis industry exploded in Canada. So I was doing a little bit in the cannabis stocks, which, fortunate for me, overall, I made more money than I lost. But for some people, it was a disaster, right? Depends what time you get in. That's what always happens with a speculative, newer type of industry. But then I slowly started doing some research. And the first video that I really saw where I started getting a taste and of understanding for dividends and investing, right? Long-term investing was when I saw an interview with Kevin O'Leary. So definitely one of my first and biggest influences, in terms of investing. So I heard him talk about, dividends and his story, the story about his mom and how she just invested in like Bell Canada throughout the years and reinvested those dividends. So that's when I started falling in love with really the concept of a passive income, right? Of dividends, of just holding the stocks, getting paid. Doesn't really matter what the stocks do short, medium term, as long as I was getting that income. So I started with, Canadian bank stocks and Bell and things like that. And slowly just evolved. And to the type of investor that I am today. So that's in a little nutshell, really the story of how I got here with this investing style.
And today you would classify yourself as just a dividend investor.
Not really. I would say I am a income investor. So my channel is called Passive Income Investing. So I would say that I'm a passive income investor. What does that mean? Well, I am investing to generate passive income. That is my primary objective. I'm also more of a passive investor, which means that I'm not looking to flip, swing trade anymore, time the market. I don't really watch the news in terms of what's happening. Most of my portfolio, like 70% plus, and probably even a growing percentage of it, is going to be really in like income-based index funds, like an S&P 500, NASDAQ 100, or other diversified funds. And the bread and butter of my strategy now is the covered calls. I don't do them myself. I'm not an options trader. I don't even have options enabled in my account. I let the professionals manage it. So luckily for me and my community, the covered call income space, or the covered call ETF space, has absolutely exploded starting in right near COVID. I would say COVID, there was always some covered call ETFs, but it's very, very limited. Like on the US market, really besides QYLD, there wasn't that much else. The Canadian market, however, expanded and started growing in terms of, I'm talking about the covered call space, income space, a lot more rapidly than the US market, or before the US market, a couple of years. Now, this year, last year is really where the US market is completely exploding in terms of income-oriented products, right? You got the Yield Max, Defiant, all these providers. BlackRock's in the game now. Invesco just launched their own NASDAQ 100. So there's like dozens of S&P 500 covered call ETFs, NASDAQ 100 covered call ETFs, Russell, and other option strategy. It's no longer just QYLD. There's plenty of options. So the market has exploded. So to answer your question, I would say I'm an income investor, not a dividend investor. So in my opinion, and feel free to chime in here, I think there's three styles of investing. I'm not talking about trading. I'm talking about long-term buy and hold investing. Okay. There's the growth style, there's the dividend style, and there's what I do is the income style. So the growth style is easy. It's basically putting your money in an S&P 500 growth ETF, passive index ETFs, buying the whole market, and, just to have maximum growth or net or maximum performance, maximum total return, whatever you want to call it, over time for a long period of time, right? Probably the most popular classic way of investing where you can't go wrong. Warren Buffett suggests just do that to 95% of people. Just buy an S&P 500. That's growth. The dividends, which I think is what you do, you're focusing on dividend stocks only. So you could either buy individual dividend stocks, or you could buy dividend ETF, like your SCHDs and your VYMs, all, the Vanguard. So just, you're narrowing it down to just the dividend stocks, which tend to have less volatility than the overall market, because dividend is just profit sharing, right? It's just a portion of the profit. So dividend stocks typically are more stable, profitable companies already, right? Johnson and Johnson, JP Morgan, Bank of America, et cetera, et cetera. Income, what I feel I am, an income investor, just takes a little bit further, where your focus is really to generate maximum income every single month. So you could still have the S&P 500, you could still have dividend stocks, but you're adding an option strategy. Covered call is definitely the most popular one. There's other ones, there's put strategies and mix and things like that, but mostly it's really covered call strategies. The goal is not necessarily maximum total return, although it's a consideration, you don't want to ignore it, but it's to generate maximum passive income. Really, the idea of why I started this and continued it and grew it is to get financially free, to gain my financial independence. In my opinion, my style of investing is the best way to get there the quickest. So, if you need $5K a month to pay all your bills and pay all your rent, once you get to $5,000 a month of passive income, technically you're financially free. It doesn't mean you're Scots-free and that's it, you could quit everything and whatever. It's not really because you want to quit your job right away, but it's just so you want to have that relief, that pressure off your shoulders, where you could live day to day, and if you have an emergency, if you lose your job, you're safe. So it's really through the style of investing. My primary goal was to reach financial independence, which we did at the end of 2019, right before COVID. We did it by selling off our paid off house, investing it all in a portfolio of different things. But 2020 till now, my strategy has evolved and changed, as well as the covered call space and the ETF landscape. So in 2020, when I started, a lot of these funds did not exist that are just fantastic, that are index based, diversified. So they were a bit more niche, the covered call market. Now it's just expanded. So it's a lot easier to be an income investor now than it was even 4 or 5 years ago. But I'm curious your thoughts. I know you're interviewing me, but what do you think? I think that's really the three styles of investing. And you don't have to necessarily pick one. You could, I know a lot of hybrid investors, they'll do 50 income and then 50 growth. They'll just put it in an S&P 500. Or some people just love dividends because it's kind of in the middle of growth and income, in my opinion.
Risk adverse.
Risk averse. Yeah, you're lowering your risks. And another misconception I get all the time is that what I do is high risk. You're adding covered calls to something, covered call strategy. It's actually the opposite. When you're adding a covered call strategy to anything, whether it's a single stock, an index, you're actually lowering your risk. Because remember, risk, it has to do with the downside, the volatility. When you do a covered call, you're lowering that downside, or you're giving a cushion to that downside, but you are capping your upside as well. So of course, there's two sides of the coin there.
No, I'm on the same page as you. When I hear you break them down as you did, I agree, right? I think you have your growth investors who are out there and, they're gunning for the growth stocks and total return. The dividend players who are out there, the dividend investors, a little bit safer. And I like your breakdown of passive income investing. It is all about obtaining passive income, and dividends help, but there's certainly a way to put some more fuel on the fire, if you will, with an option
with
spread.
Options. Yeah. So I started as a dividend investor, and I was buying bank stocks, and I was getting 4 or 5%. So the Canadian market has much more higher dividend yields than in the US market because there's more dividend stocks. So you guys have the S&P 500, we have the TSX 60, which is kind of our version of the S&P 500. Most of those stocks in the TSX 60 have fairly good dividends or high dividends because the two top sectors is financials and energy. And those are very, yes, they're cyclical sectors, but the stocks tend to have a dividend. Where in the US, it's much more technology focused, and many stocks, although some have introduced small dividends now, like Meta, etc. So, if you get the S&P 500, you're getting maybe 1.3, 1.4% yield. But if you get the TSX 60, you're getting 3% yield. So the dividend, there's more dividend stocks, or that's the focus in Canada. So it was pretty easy to get started. But, I was getting maybe 3, 4, 5% yield. Then I started getting more into smaller to mid-cap dividend stocks because I wanted to get 6, 7, 8% yield. So with time, I was really getting more and more hungry for yield, for dividends, because I don't want to buy and sell and figure out when to sell. I want to hold for a long period of time, if not forever. So why can't I get 6 instead of 4? Then it was 7, then it was 8. Then I discovered covered call ETFs where you could easily get 7, 8, even with an unlevered one. But I got burned because with those smaller cap or single stocks or single REITs where you're getting 7, 8, 9% yield, those dividends, something happens, they could get cut, or there's a strong possibility to get reduced. And that is really the biggest con and biggest danger or fear as a dividend investor, which I'm sure it's the number one fear. It's dividend cut, dividend reduction. And even with these big, amazing companies that have been having dividends for a long time, it's always a possibility. Right. So I wanted something, how can I get higher yield? This was when I went into research mode. I want higher yield, but I don't want risky stocks. How do I get that? And that's when I discovered the what is now the bread and butter still of my strategy, covered call strategy.
Let's go back even before 2012 when you started investing, because when you speak about investing, your eyes light up. I hear the passion.
Yeah, I love it. I love the freedom it brings.
Where did it come from? What was the ignition spark?
Hard to say. It's hard to say. I have to give credit to my dad because he was a great example of pretty much what not to do. But it was one of the things that I saw my dad actually passionate about. This was before online like banking. I remember he would have to go to like the bank teller to buy a certain stock, and it was like 30, $40 with TD. You know, now with online brokers, it's you could trade for free, but back then it was much harder. And he would actually watch the French, because I grew up in Quebec, the French economic channel. It played right after the news or something, and you know there was a guy who would talk about Bombardier and the latest stocks, so and a lot of more speculative stocks. So my dad will watch that and he would want to invest, and he basically definitely lost a lot more money than he made. But you know, after a while, when it went to online, and you know, I was always on the computer, you know, playing video games, and I was good with technology. He wasn't. When he had to do it, you know, the bank started telling him, you know, you could do it online. So they gave him a password, and he's like, "How do I do this?" So that's how I started like seeing the taste for first time, maybe in terms of really do-it-yourself investing. But even before that, or maybe it was about the same time, I really like economics. I mean, it was my favorite class in high school. I always liked the concept of, you know, the stock market, supply and demand, that kind of stuff. So that, you know, I have to say, like, the first time I actually saw like do it yourself investing was my dad do it. And I was kind of, you know, he would always tell me, can you do some research on this? Do some research, that's all he would say to me. He would come back from work, did you do the research? And what research you want me to do? I could just read upcoming things on a particular stock. And you know, if I knew what I know now back then, you can't make money that way. It's impossible. If you're reading something, the news comes out, it's already too late anyway. So the only way to really make money, you know, with trading, with penny stocks, in my opinion here, is really with inside information. Besides that, it's a gamble. You're really gambling. Gamblers get lucky sometimes. Over time, most of the time they lose, right? So that's how I feel about it. I never really got into it myself. I think I opened an account myself. I tried $500, $1,000. The company went broke. I lost $1,000. I don't know how much, you know, the same stock that my dad did. I don't know how much he lost. Then I just put it on the back burner, and I just was more of a saver, and met my wife. We, you know, not really, you know, my parents were with Investors Group, which is an asset manager popular in Canada. So I just put my money, you know, opened an RSP with them and just did the classic thing that most people do. Just give it to your financial advisor. They'll ask you what risk level. I said medium to medium high or something like that. And you know the general story, you hear it all the time. You're going to get lackluster returns. You know, in terms of do-it-yourself investing, that's the first time I got a taste for it. It wasn't a great taste. It was a sad taste. But regardless, bittersweet. Yeah. So, you know, 2012, 2013, when I started opening my own account and playing around, I was doing it mostly for fun, but I was putting, you know, 4 or 5, couple of grand, you know, 10, not more than 10, 15 grand. I would never, most of the money was going into paying down, most of the disposable income was going to paying down the mortgage. It's really once the mortgage was paid, when I'm like, okay, we're going to have such a big disposable income. When I went, like I talked about it earlier, when I went into research mode to try to figure out, okay, what am I going to do? So that's really when I started getting into investing instead of speculating.
And when it comes to financial freedom, where's that fire come from?
I mean, starting at an early age, you know, because I grew up, you know, working class family. I wouldn't say poverty, but you know, right on top of the, right up that notch above that. I saw my parents, you know, struggle sometimes with, you know, doing things extra than just surviving. So I realized right away, like, money is really freedom. And I realized that right away as a kid. So I didn't know about investing at the time or passive income, but I realized early on that, you know, if you really think about it, write down all the problems you have in your life. How many of them could be solved with money? Probably in the 90%. Right. So I realized, you know, money solves a lot of problems. It increases your convenience in life. It lowers your anxiety and your stress a lot. It gives you opportunity and more freedom just by working and you know, being independent and starting to pay your bills and having responsibility. You quickly realize, okay, if I made more money, it would be life would be a lot easier. So I'm a guy who really likes when things are easy, simple, easy. I don't want to be stressed at all about money, especially. It causes a lot of people stress, man. It
Sure.
causes a lot of divorces. It causes a lot of problems, a lot of criminal stuff. It's because people are stressed, right? So with time, I tried to figure out a strategy where how can I make, make my own paycheck, because after, the first couple of years when you work in a big company, you're young, it's great, but then as time goes on, it dawns on you, like, can I really do this till 60, 65? We couldn't, my wife and I couldn't see ourselves doing it. So it's really about that freedom. If you're not financially independent, you're financially dependent by
Sure.
default. You're dependent on a job or your family or the government, even worse. I really don't want to be dependent on anybody. So that for me is so important. And money can provide that for you. And not only money, but you need the knowledge too of what to do with the money as well. Because there's some people who are millionaires and they're just a mess, right? They have no idea. So that's what I would say. Hopefully that answers your question. It's really, with time and experience, you realize, holy crap, I don't want to go to it's a nice day outside and we're stuck in the office. I look around, there's 50, there's 60-year-olds. They're celebrating their 25, 30, 35-year anniversaries. They're getting a $300 watch. Everyone's clapping. My wife and I are looking at each other like, this is scary. This is a nightmare. So, I was always more of an outlier in the way I thought. I never liked doing what the normal crowd does. I was never a follower. I always wanted to do my own thing. All these kind of little factors combined brought me to where I am now.
It all matters, and it's like a dream, right? Financial freedom is the dream, and I want to ask you this question when it comes to everybody else, probably a lot of the viewers who are out there. Like, so many people are going to try to obtain financial freedom, and so many people don't actually commit to financial freedom. What do you think prevents people from actually committing?
It's hard. It's the number one it's the number one thing, my opinion, that people should commit to as soon as they get their first paycheck. You have to be very, very disciplined. It's hard because you have to be disciplined, right? If you want to get your financial freedom in 10 years, 15 years, you could do it. It's easily done, but it takes a lot of patience. It takes a lot of discipline. It takes a lot of sacrifice, especially if you're just a regular person like me and like you probably, I don't really know your background, that family doesn't come from money, have to go to school, have to go to work, and you start with zero and you have to build up your wealth. You get a mortgage. When you start doing all those things, you quickly realize that, holy crap, if I'm just gonna live pay to pay, or not necessarily pay to pay, some people do that. First of all, you're gonna have to work until you die. I mean, that's a no-brainer. So it's long and it's hard. So that's why people, especially now, we're getting more and more impatient. The young people want everything right away. It's not like the older generations where they always play the long game, right? Even if they knew nothing about investing, their house is typically their investment, their real estate, and that's why a lot of them have done really well. But that's another discussion. They live in a big house that's worth probably 10 times more than they bought it for, but they're not cash flow rich, right? They're house poor, right? I think is the expression. So I think most people, also, there's a, if you just search passive income on Google, or how to invest for passive income, it's almost like the same as if you Google how do I lose weight, best weight loss. It's just boom. All you're gonna get is just a million different experts, opinions, ways of doing it, strategies. So I think that also confuses people and they just give up. It's too hard, there's too much. And they're busy. They're busy working, and so it's hard, they're busy, or they think it's a myth or a pipe dream. So I think that's probably number one reason why they don't do it. But as we know, it is possible, it is doable, but it does come with some discipline, patience, and sacrifice at the beginning.
Do you think it's the mindset is, I want to say, trainable from where we are
Yeah,
today?
of course, you could train your mind for anything that you put your mind to, right? You could do whatever you put your mind to. So it is trainable for sure. First, you need to realize that it's possible, and it's much easier when you see Well, that's it. When you see stories on, like my story or other people, I think MSNBC has a series where reach fire, and there's couples, and you realize that these stories, they all kind of sound the same. The steps they did are the same. So it's like, I think about, it's like losing weight. Not a hard thing to do. It's not rocket science. It's been known for forever how to do it, and the formula, it's just there's different little ways of doing it. Everyone has their own style, but it's very doable. A lot of the same steps and discipline is required, right? It's not rocket science. It's not hard.
So get to it, anybody who's out there.
Yeah, you
Adrian,
have to first realize it is possible, but it does come with some sacrifice. And the goal is not, okay, what do I do? Like, there are some first steps that you have to do. Like, Dave Ramsey has the baby steps, which I like, which really makes sense for, it's a really basic plan that anyone could follow. So you have to do the steps. You have to get out of debt. You have to, if you're living to pay, you'll never reach fire, right? You have to save at least a good chunk of your income. When our mortgage was paid, we had 70% of our income. We had 70% disposable income. So the more disposable income you have, the more it accelerates. But it takes time. It takes time, especially at the beginning, because you're in a lower level position. You're not getting paid as much. You probably have, maybe a car loan and your mortgage. So you have to be very, very organized, disciplined, and you have to know in advance. You have to have goals and a plan. If you're married, you have a significant other, you have to be on the same page. There's a couple of things that you could do early on that will really help you get there a lot quicker. It's never too late to start. If you take the steps really, really early, if you have the knowledge really, really early, it helps a lot. You could easily do it. If you have a regular, normal job, you're both working, I would say, typically, if you're really disciplined, you could do it within 10 to 15 years, no problem. Obviously, some people take longer, if they have more expenses, if they have children or not, there's all kinds of different factors. But the formula it's there. It's not rocket science. It's not like some unknown thing. You got to do it, but doing it is hard.
what were some of the biggest sacrifices that you made on your journey?
Biggest sacrifices. I don't think we made that much. I mean, my wife and I were always, we never were the people who live pay to pay, and we always live below our means, always. That's the most important step. Step number one is you have to live below your means. If you're living above or at your needs, you'll never make it. There's got to be a portion that you're saving or investing, or in our case, paying down the mortgage with. You have to live below your means. So that comes with some sacrifice, but again, that depends on your personality. Luckily for us, we don't care how other people live and what other people think of us. I think that's a very big mental obstacle, or what's expected of you from either your friends or family. The expression keeping up with the Joneses. There's a lot of pressure now to have, this clothes and a new car and all that stuff that doesn't really matter and that depreciates over time. Once you look at the world through the lens of an investor, an asset owner, things change really quickly. You get smart really quickly. You realize that that's just a waste of time. It's a waste of money. So you have to be true to yourself and to your partner, your wife or your partner or whatever. You have to be on the same page, and don't let yourself get influenced by your friends, your family. Oh, you should be doing this, or that kind of thing. That's really very, very important as well. You have to really focus on your goals, your objectives, and how your life is going to be in 10, 15 years, not what they think of you.
And in terms of the total value as we speak of your portfolio, you could
Yeah,
ballpark this one. Where are we sitting?
a little over 1.5 million Canadian
Okay.
dollars. So I don't know how much that is in USD. Obviously, it's less in USD, maybe 1.1, 1.2. Depends on the Canadian dollar as well. So we could talk about portfolio. I consider myself that I have two entities, a main portfolio that is a combination of my regular, non-registered account, and our two TFSA accounts, which I believe in the US are equivalent to your Roth
Yep.
right? They're called tax-free savings account, which I hate that word. Should be tax-free investing account. Unfortunately, just people leave cash in there, which is just horrible. That's my main portfolio. It's roughly about 1 million Canadian getting there, or I think it's right there as of this week. And then we have our second entity, which is a combination of 3 retirement accounts, registered retirement accounts, which would be equal to you guys' 401k, which are just dripping. They're just compounding. They're still, everything is an income investment. So there's either, there's monthly income, but for that second entity, it's automatically being reinvested. I don't know when I'm gonna sell them and move them to the main portfolio. The main portfolio, there's no drip, there's no reinvesting automatically. That all the money comes in. That's kind of how I say that's what we live off. The reality is, that source of income is combined with my other sources of income, business income, that gets all in one pot. All our monthly expenses get paid, and I reinvest whatever's left over. That's kind of like my very, very simple monthly routine that I do. It's always important. You want to grow your assets, and you reinvest as much as you can, and you keep adding more to just you building your passive income every month. So my goal is not necessarily to get to $4, $5, $6 million. I don't really care that much about the net worth. So that's the difference between the growth investor and income investor. So I'm trying to increase my income every month, not necessarily my net worth. Growth investors, they just want to see that number grow,
Sure.
right? I want to see my passive income grow, because if I'm making, $10,000 a month, and next month it's 10,200, then 10,300, and then 2 years from now it's 11,000. I just have more options in life. I have more doors available to me, more lifestyle choices I can make, more vacations I could take, whatever it is that you really want to do. Some people have hobbies, some people that are very expensive, some people like to travel, so everyone has their own way that they want to spend their money. But I'm always looking to increase my income instead of increasing my net worth. But the net worth obviously goes up also if you're reinvesting a big portion of the income as well.
Sure. And you and your wife moved out of Canada. Was that a strategic financial move to obtain FIRE?
We hit FIRE at the end of 2019 when we sold the condo, invested everything in the portfolio. So we hit FIRE like 3-4 months before the COVID market crash. So this is another reason why I'm so confident about this strategy in my portfolio, because I've learned a lot, and I see that, I did the test, and which is mostly psychological, because the whole premise is I don't really care what the capital does or the account value does in my portfolio month to month, year to year, as long as my income comes in consistently. That's my priority. So we hit financial freedom in the end of 2019. My wife quit her job first because she wasn't happy. I stayed because, again, I said this before, just because you hit your FIRE number doesn't mean we're all gonna quit and whatever. It's not about that. It's about being comfortable. And so I stayed at my job at Air Canada. I had a good job. A year later, because my wife was able to quit her job, that's why we were able to launch the YouTube channel. First of all, we were stuck indoors, and COVID, it was pretty bad in Canada. Don't want to go there, but we were locked inside for quite a bit. That's when my wife, okay, I have free time. She's more the back end, so launching of the website, starting the channel. We had no idea, but we work in the tech field, so it definitely helped speed it up. We're not podcasters or doing videos. If you look at my first couple of videos, I look completely ridiculous. It's like I'm just reading off a piece of paper. It's so bad, but that's what got us able to start this side business, which only became a business really a year later. Like, it took a long time for it to grow, but we really started the channel to send people, because we kept getting asked by friends and family and people at the gym and whatever, okay, what do you mean your wife quit? Your wife quit? She's not even 40 yet. She's, you're in mid 30s, and what is this financial, how did you do it? So we would spend time explaining it. It would take like 30 minutes, 45 minutes. And then at the end of it, I have no idea what you're talking about. It was like a complete waste of time. So it's like, why don't we make a YouTube channel and explain dividend stocks and our portfolio and things like that. So at least we save time and send people there. So once you hit fire, once you get older, I'm sure you'll agree with me, you understand very quickly that the most important commodity in life is time. It's not money. It's you can't make any more of it, right? That's how it happened. So we did it in 2019 anyway, to continue the story. And I might have my years mixed up because it's a while now. But once I quit my job and we were focusing full time on the channel, the natural progression is, why are we staying in Canada? We just need as long as we have the internet, we could work. Plus Canada, as you know, very known for high taxes. We decided to let's spend, our dream. We both hate the winter. I mean, we're Italians, cold weather is not, we're not skiers or anything. We just despise the cold weather, the winter, which in Montreal is, our hometown it's long. It's like 8 months. It's like 8 months of the year where it's not necessarily snowing for 8 months, but you can't go outside without a jacket. I mean, it's just crazy. So we said, let's just spend a winter, 3.5 months, snowbird, like retirees do. It's just, let's check this out. So we started, where do we go? First we planned Dominican Republic, because that's where we always went for our vacations. We really liked it. But then we started, there's a million options, as you know. There's Costa Rica, there's Panama, where we are. Mexico is very popular, Florida. And there's another Canadian couple, the Jameses. I can't remember, Project Life Mastery, I think his channel is, which, they're like really high net worth. Like they had Amazon FBA businesses, they sold them. And we saw that they moved. First, they were trying to move to the U.S., I think, California, and then they decided on Panama. And now they're also in Panama. They're actually not too far from us. We know where they are. We never met them, but we know they're there. But they go back to Canada in the summer, I think. So, but they have a lot of money. So that's what put Panama on the map for us. So let's just try Panama, see how it is. So then, okay, where in Panama? It's a small country, but there's mountain areas. There's Panama City, which is very developed and modern. But we don't want the city, we want beach. So beach, discovered Coronado is the most popular beach, place in Panama. So we went there, we took an Airbnb for 3.5 months. And I'm telling you, man, things move so quickly. 2 months in, I would say, because you can't make the decision within a week or 2 weeks. You gotta live there, right? 2 months in, we realized we could live here. Why do we have to go back home? I don't understand. Well, why do we have to go back home and then winter? It's still going to be cold. It's going to be March. It's still freezing. Why? There's internet here. It's beautiful 365 days a year. Same temperature. We found that the lifestyle is much calmer. It's much better. The people are different. We loved it. In short, we fell in love with it. We talked to a lot of people, and we found a place to rent. We got our lawyer. It all happened even before we went back to Canada. We signed a rental agreement. We started the immigration process, which it's almost completed now. It takes about 2.5 years to get your, wow. It's not hard, but, and then we went back to Canada. I sold my cars, got rid of our stuff. Luckily we were renting, so it was a lot easier. And 3 months later, we were back in Panama permanently. So it happened really, really quickly. But when my wife and I put our heads to something, especially when you're financially free and you actually have the time, you don't have a 9 to 5 to report to, it's a lot easier to get stuff done. So that's the story. And we've been in Panama ever since June 2022.
Let's dive in a bit to this portfolio. If any of us want to follow suit to Panama and actually become financially free, what's the setup? Like, what's the process, the makeup? Are there individual stocks in there? Are you all just covered call ETFs at this point? What's it look like?
I'll give you the rundown basically. And this is just my Excel sheet that I show every month on my channel. So hopefully you could see it. Like I said, I have two entities. My main portfolio, which is what you're looking at, which is what I live off of, right? The income comes in. And then I have the retirement accounts, which is just a separate entity, which is just all on drip. So I'll do the retirement accounts quick because they're very, very simple and easy. So main position is QDTE. So QDTE is a NASDAQ 100 covered call ETF. So you're literally investing in the NASDAQ 100 index, but these guys do a covered call strategy. And it's a pretty unique fund. And again, there's QYLD, there's JEPQ, the ones from JP Morgan, right? JEPI, JEPQ, the biggest covered call ETFs in the US. So I'm sure your audience will know about these, but like I said, it's exploded in the US. So I've made some changes, and I decided that for both accounts, we're going to go with the NASDAQ because, hey, long term, NASDAQ has beaten the S&P 500. There's more technology. I strongly believe in technology stocks. Am I going to go all in just on technology stocks? No. So I like the NASDAQ 100 index for that because it's about 55%, right? But you're still getting Costco, you're still getting Pepsi, you're still getting some healthcare stocks, but it's considered the technology index. So these amounts are in Canadian dollars. So I have about 270 grand in my account, 267 in my wife's account. And the biggest positions are QDT. So this is just NASDAQ 100 covered calls, weekly dividends. So this is a unique trait of the Roundhill products. They have weekly dividends, which I gravitated to because I'm dripping and I like compounding weekly instead of monthly. Because let's say the NASDAQ drops, then shoots up 2 weeks later. If you're doing a monthly compounding, I think you don't get it. You don't, DCA as much, dollar cost averages. But if you're doing it weekly, there's more of a chance you could catch it on the down day because this is just long term. So I wanted to go down, and the weekly I think is interesting. So those are our two main positions. I also have SVOL, which is fantastic. One of my personal favorite income ETFs, very unique. On par with performance, very close to the S&P 500. I've had the creator on my channel many times to discuss it. This is just a kind of a secondary position in my wife's account. There's also a RIV, which I'm planning to swap into SVOL. RIV is another one of my secondary, I would say, non-core positions that I'm eventually going to get rid of as well. I'm probably going to swap it into SVOL. I just like SVOL a little bit better. RIV is good, it's okay, but it's mostly in fixed income stuff, and I just prefer SVOL, basically. And I want to make my retirement accounts as small and slim as possible and just have maximum compounding effect. And I also had a leftover pension from my work, which had to go in a lira, which is like a locked-in retirement account, basically. And I just put that all in a Bitcoin. And I decided to go with Maxi. So there's a couple of income Bitcoin options on the US. There's YBTC, which is your classic covered call, but I kind of like Maxi a little bit better because you are not sacrificing as much Bitcoin upside. Like it's basically they invest in Bitcoin futures like BITO does, and they do like short dated call and put spreads just to add a little bit of income to that. So it's just a cool way to, an income way to get a little bit of income while being invested in Bitcoin. So this is pretty much my retirement accounts. Makes up about 34% of my overall portfolio, and it's completely on drip. It's just being reinvested. I'm not sure when I'll sell it, when I'll use it. I have no idea yet. It's just, mostly in the NASDAQ, mostly in the American stock market, as well as kind of like very correlated to the S&P 500. So it's pretty much, in US stocks on drip.
Sure.
In terms of the main portfolio, so this is my main portfolio, which I guess you could put in brackets, which I live off of. So there's no drip here, there's no automatic reinvestment, and these are all in Canadian listed stocks because for me that makes the most sense in my Canadian accounts to have Canadian listed funds and ETFs. Doesn't mean it's Canadian stocks. They all mostly invest in American stocks as well. Just more tax efficient for me as well. So the first four I would say are my core positions. They're all diversified. This is basically the S&P 500. This is literally the S&P 500 with covered calls, with 25% leverage. So I would say my favorite type of fund is really index based with covered calls and a little bit of leverage. That leverage really helps to get your performance up. Because whenever you're writing covered calls on something, you're sacrificing performance upside. So that leverage helps to make up that gap. So you're pretty much looking at close to the same performance as the S&P 500. Of course, if it's on a rocket ship, you'll get less, but these really more will shine, just like all covered call strategies during more of a flat or down market. So as you could see, that's just 30% of my portfolio. These two positions are practically the S&P 500. This one is the NASDAQ 100, big position here, 12%. Again, with covered calls, with 25% leverage. This is a split fund, which are really unique investment vehicles in Canada. It's basically a closed-end fund that's leveraged. That's really all it is. This is just the global dividend growth split fund. So it's just the best blue chip dividend stocks all around the world. Something you would probably like if you were in Canada for sure. So it's mostly North American, but you got like 25% some European and Japanese, Australian dividend stocks. Maybe I haven't really checked lately, but really, these four, it's really diversified funds, either index based or not, but all big cap blue chip stocks, primarily in the US. That makes up the majority of my portfolio, and it's probably going to make up more and more the majority. Then I have some sector specific funds. So I do have one that focuses on real estate. This is also a closed-end fund that's leveraged. So it invests in big cap REITs, mostly in Canada, but also in the US. So because my tax situation has changed, I am planning on selling this one as well. I don't want to get into the story why, but a great fund. These guys, Middlefield, are really specialists in real estate. I don't own any real estate personally, so that's the original idea of why I went into this. And I've been adding more and more and averaging down because REITs have been under pressure in the last couple of months last year, but now they're starting to pick up. Not rocket science, right? Tied to interest rates. These two positions, I would say, are my core remaining Canadian positions. So this invests in the top 10 Canadian financial stocks, top 10, 11 Canadian energy stocks, so oil producers and pipelines. So these are more specifically in my tax-free savings accounts. They're very high yield because, if I'm going to if I'm going to invest in something sector specific where I'm going to have more sector risk, I'm going to want higher yield, higher reward. So, if these would have 12, 13%, I wouldn't get them. But because they have 15, 16, 17% yield annual, that's why I have them here. So about 18% of the portfolio together. And then I have my more minor positions or funner positions where, because this portfolio, this style of investing is so boring, I gotta have a little bit of fun, I guess. So there's been a rise in single stock covered call ETFs in both Canada and the US. In Canada, I like them a bit better because you have a little bit of that leverage, 25% leverage. And by the way, it's just regular leverage. You just borrow the money. So it's based on the interest rate of the day. So this one is basically an ETF that holds Tesla. So it's a single stock ETF, just holds Tesla stock. They write covered calls on Tesla stock on up to 50% of the portfolio. And there's 25% leverage. So it moves in tandem with Tesla stock pretty much, but every month you get a nice dividend. And obviously Tesla is a more volatile stock, so the yield is going to be higher because covered call premiums are based on volatility. So I got over 20% yield with this one. I have this one. I'm not really a big fan of fixed income, but the yield was so good I had to get it. So this is just, it's basically TLT. Everyone knows what TLT is from BlackRock, long-term US government bonds with covered calls. Fairly aggressive covered calls. You're giving up most of the upside to get that 16% yield. Are you still with me?
Still here, yeah.
Okay. Yeah, so that's HPYT. These, and like you can see the percentages, they're smaller positions. I do have 5.5% in Bitcoin. This is a Bitcoin covered call ETF, so there's no leverage. It's just Bitcoin exposure, physical Bitcoin exposure with covered calls. And the same thing for this one is just Ethereum with covered calls. So that's my main portfolio, and every month I get gross over 11K Canadian. This is all in Canadian dollars, by the way, because these are all Canadian listed. So the overall yield's close to 13.5. I get about 11,100 a month. I do pay a 25%. Sorry, I should have mentioned this earlier. So this main portfolio is a combination of three investing accounts. My TFSA, my wife's TFSA, which would be similar to you guys, is our Roth. And our joint non-registered regular account. So three accounts put together. That's what you see here. And you could download this from my website. It's free. There's also hidden columns here where I actually specify, you know, how many shares in the TFSA versus the non-registered. So basically, everything in the non-registered or the regular account, because I'm a Canadian non-resident, these are Canadian products, Government of Canada, which is the CRA, Canadian Revenue Agency, has to get their cut. So the universal withholding tax rate in Canada is 25%. You guys, it's 30%. So basically every month I have to pay 25% withholding taxes from the dividends right off the top in the non-registered regular account. So it comes out to $2,093. But at the end of the year, the following tax year, I get the portion that's classified ROC and capital gains back. So I did an estimate of how much I would do based on an estimate of, you know, how I feel, or, you know, how much of a percentage is going to be ROC and capital gains. It's just an estimate, and I get most of it back. I get about 1640 back. So net is really about 10,700 Canadian right now. And every month I you know, you could see my objectives here. I always try to reinvest at least $5,000 a month, because the goal, like we discussed before, I don't really care that much about growing my net worth. I care about growing my income, my passive income stream every month. And there's only one way of doing that. Just keep on investing, and whatever I select to invest in that month, it's pretty tactical. It depends which ones are down, but typically I'll always do a majority portion in one of the core positions. I want to make the core diversified positions, you know, between 70 and 80% of my overall portfolio, maybe 10, 15 in the sector specific stuff, and then maybe less than 5% on things that are, for me, a bit more fun, like, you know, these single stock, where it's basically you're playing the single stock, right? They're just running a cover call strategy for you on it. So that in a nutshell is my portfolio. So it's, you know, it's a very boring, low risk portfolio in my opinion. A lot of people probably will disagree looking at it, but it's mostly people who just don't understand these funds and what they are, and, you know, what stocks there's inside, and don't understand the cover call strategy. Any normal person will know that if you're adding covered calls to something, you are lowering your volatility, you're lowering your risk. But because these have about 25% leverage, to me, like something like these two, the risk level is pretty much identical to Vanguard S&P 500, like a VOO. This would be similar risk to a QQQ, because it's basically NASDAQ 100 with covered calls, lowering your risk, 25% leverage, raising your risk. They kind of balance each other out. So it's almost, you know, the risk level is about the same as the indexes, my opinion here. So that's basically it. And, you know, this has obviously evolved over time. I unveil my portfolio every single month. You guys could subscribe to my channel to view the monthly updates, what I buy every single month, all my book prices, all my transactions. I'm not trying to hide anything at all. I'm completely open and honest. That's one thing I always wanted to do with this channel, and really show what I'm doing, what I'm investing in personally. So that is basically it, man. I don't know if you have any questions or anything like that, but that's the spiel on the portfolio. I stopped.
First question we have here. I want to go in this direction. How exactly do you select the stocks to put in there, or the ETFs rather? Do you just go based off of yield? And if someone's looking to follow suit and build a similar portfolio, should they be targeting yield first and foremost?
I would say no. You shouldn't look at the yield first, because you'll just be dazzled by the highest yielding ones, and the highest yielding ones tend to be a little bit more misunderstood and higher risk. They'll probably be single stock ones or sector specific ones. I would say the best thing to do, in my opinion, is really build a foundation first. If you're a newer investor and you like this style of investing, you don't want to try to chase yield. You want to still understand what you're investing in. So I think the best strategy is to build a foundation first. And there's no better foundation than index-based diversified ETFs, right? So just like a growth investor is building their foundation, they'll probably start with the S&P 500, maybe add the NASDAQ 100, maybe get an all-in-one like a VT type of thing from Vanguard. You actually have the same type of products on the income side. So I feel those should always be the core, the majority of your portfolio. And at least start with those if you're a bit newer. I would say at least 75% of your portfolio should be those high quality diversified funds, either index based or stock picking that's has a collection that's you're diversified in sector. But of course it's always easier to just pick the S&P 500 with covered calls ETF and things like that as your core, as your foundation, so you have a broad exposure to the market. And then as time goes on, then maybe you could start adding some sector specific covered call ETFs. Maybe you really, really like the technology sector, the financial sector. You want something more defensive. You want to add a little bit of a healthcare utility sector. So in Canada, the market is absolutely huge for covered call ETFs. You have the diversified and or index based ones. You have the sector specific ones where you'll get like 20 technology stocks or 20 or the big 6 banks in Canada in one ETF. So I would say those are going to have a little bit higher risk because you have sector risk compared to the diversified ones. So you want to add those, fine, but get your experience, make the core your foundation, the diversified ones first, or index based ones, then start getting maybe the higher risk ones. And if you're feeling lucky, maybe a couple of percent in the single stock ones. If you really, really like that stock, you got to like that stock. You can't just say, oh, the Tesla 20% yield, I'm going to get that. It is an investment in Tesla, right? Yes, you're investing in an ETF that has a different stock symbol, but if you look at the name and all the assets inside that ETF, it's Tesla stock, it's Nvidia stock. So those are going to be the highest risk ones. Obviously, just like in growth investing, your highest risk assets are your single stocks because you have a single point of failure, right? So a lot of the same concepts are going to apply with income investing versus growth investing or dividend investing. It's the same concepts, really a lot of the same concepts apply, but it really depends on your goals, your objectives, how much volatility you're willing to take. If you're in your 60s, 70s, and you just want the smoothest ride, just go with the diversified index-based funds. If you're a bit younger, you could take a little bit more of a risk. And by the way, if you do that, the best thing to do is put those in your non-registered account. So at least you could do something with the losses in case something goes wrong. With a single stock covered call Tesla, which is the same risk level as investing in Tesla, you got to expect more volatility, maybe more reward, right? Higher risk, higher reward, but higher risk, more of a chance of loss as well. So that's what I would say if you're starting to, think about investing this way.
I'm curious to know from your vantage point, what do you think
Yeah.
the most common mistake investors are making, either when they start off on this journey to actually live off of passive income, or they're in the throes of it and they're building it, but they're still not quite there?
Well, specifically to investing in general, I think the biggest mistakes people do is they don't understand the difference between investing and speculating. So investing is really a long-term view, 10 years plus. You're looking to buy quality assets that you could hold forever. And speculating, aka gambling, is basically you're just trying to make quick flips. So a lot of people don't understand that. So they get obsessed with the day-to-day, week-to-week, month-to-month stock price movements. It's a big waste of time. They get worried. Maybe they panic sell. That's the number one mistake I think people make. They don't understand the difference between investing and speculating or trading, swing trading. So that's number one. You want to be an investor, you're going to be for the long term. So you got to have a long-term horizon. I think newer investors should just stay away from single stocks altogether. That's my opinion. I think you could save yourself a lot of heartache, a lot of disaster. No matter how amazing the companies are, whether you're investing in some big blue chip bank that's been around for a long time, you just never know. Start with ETFs, start with index-based ETFs, go slowly, go with the basic stuff first. In terms of income, specifically for income investors, of course, there's some people that just chase the yields. It's a big mistake. They don't really understand what they're investing in. So, on the US side, for example, there's a lot of single stock ETFs that have these crazy high yields, like the yield max ones, and people are just investing in the ones that have 60, 70, 80%, but they're really investing in Coinbase and Tesla and all, for the yield to be that high, it means the volatility, aka the risk on the stock, is high. So of course you're going to get higher yield and cover call premiums with a Coinbase stock or a Tesla stock or a more of a, Roku or a Snowflake or, more volatile companies, but they don't, they're just yield chasing, and yeah, they're making 40, 50, 60% yield, but they don't understand the fund and really what they're investing in. So, it's kind of investing in general, but don't go yield chasing. Understand what you're investing in terms of income invest. Another mistake people do, they just focus on the stock price. They say, oh, this has NAV erosion, this has stock price erosion. I see and hear that all the time. So when you are analyzing any stock, even a dividend stock like you focus on, that has a dividend, it's completely useless to just look at the stock chart. That only gives you the stock price return, the price return, not the total return. So in income investing, a lot of the stock charts don't look good, don't look great. They look flat or a downward trend because most, if not all, the returns are coming from those big dividends and distributions that are being pumped out. You do not see that in the stock chart. So someone could look at a pretty good income investment that has high yield, like 15, 16% yield, like an SVOL, for example. And you look at the stock chart and it's down and then it's flatlining. And people will write, how is this a good investment? Well, they completely ignore, they don't understand that this gives you, 30 cents dividend a month, that's 16% yield. And it's actually beating, SVOL, I don't know if it's still beating the S&P 500, but it's very, very close to the S&P 500. You would never see that comparing the charts. Always got to look at the total return, not the stock price return. Just, you got to curb your expectation, right? Another thing is that some of the, and this is where you have to analyze the fund manager, the strategy of the fund. Distributions could vary greatly. Some fund managers, especially more in Canada, they're more conservative. They tend to have a set amount, 12 to 15% yield, which I feel is kind of, I think 10 to 15% yield. You could probably say the fund is safe to live off of, which means the capital will remain more or less stable in your account while taking out all the income. But if you're getting, 30, 40% yield, you have to expect a downward stock chart. And if you want your capital of that investment to remain steady in your account, you're going to have to be ready to reinvest some of the dividend, if not all of it. If not, maybe that particular investment is not right for you. You could go with another investment. So that's where it really depends on your goals, your objective, your personality, things like that. So, but of course, the number one mistake in the whole world of investing is not starting sooner, right? I'm sure you could agree with that.
I think every investor ever, it's like the primary mistake.
I wish I
not starting
started
soon enough.
earlier, like
Yeah.
for sure. Like who knows where we would be, right? If we would investing in right after the 2000s, or I think I started investing in the early 2000s, which was right after the internet crash. But it just keeps going long term. It just keeps going up. So
The eighth wonder of the world, as we know it
yeah,
to be.
compounding interest. Yeah.
Adrian, I'm curious to know if you were to meet with, grab a beer with, or a dinner with an investor that has been an icon to you, who would it be and why? And what would the conversation be like? What type of questions would you ask?
Yeah, that's a tough one. I mean, I know a lot of people will say Warren Buffett, but he's like 94 now, and don't shoot me in the foot or anything. But I think Warren Buffett's a bit over. Is just too hyped. He's hyped up. He's doing a great job with his image and everything, but a lot of people don't know the history of Berkshire. And basically, he's a corporator. Him and Charlie Munger. I mean, they were sharks back in the day, so overrated in my opinion. But I do, like his advice and stuff. But I would have to say Kevin O'Leary for me, because he was my first kind of inspiration that really made me switch from swing trading mentality to investing mentality, dividends. He's obsessed with cash flow, just like I am. You see that on Shark Tank. He loves royalty deals, and he likes the concept of always getting paid, always getting cash flow. I doubt he would like the covered call strategy, but I would still love to sit down and ask him about it. And he also seems like a fun, cool guy to me. He plays good the guitar. He likes cooking. He's Canadian. I just like his personality. So I would love to, not just talk about investing, but also his journey and things, what he's seen and what he thinks is happening. He's more of a conservative investor, and I think I would say I'm a fairly conservative income investor. There's, as you could see, like 60-70% of my portfolio is just index-based covered call ETF. So I would say Kevin O'Leary.
And as you're living off now the passive income, which is something, again, we're all really striving for, is buying our
Yeah,
time back. I want to know, do you focus at all on macroeconomics, the day-to-day movements of like what's happening? You mentioned even
not
with
at
the
all.
REITs, like interest rates. Do these all
Not at
factor
all.
in or not so much?
No, actually, I've been every day that goes by, every month and year that goes by, I actually look less and less at my stocks and how they're doing. Because the more time goes on with this strategy, the more you realize it doesn't matter. It doesn't really make a difference. So no, I don't really, I try to stay kind of in tune on the really big major headlines just because I have an audience now, so I kind of have to be and I have to stay on top of the news. But it's not that I'm checking or studying macro to know what to invest in next. I just want to be in the market all the time.
It really all boils down to the simplicity. Adriano, I have one more question for you. It's my favorite question to ask all investors who join me on Masters of the Market. If I were to throw you 10,000 US dollars, we'll put it into Canadian if you'd like, but if I were to throw you 10,000, where would you put that 10K right now? It could be a fund, an individual stock, and the reason why.
And in an index-based ETF. So I'm an income investor, so it would be income oriented, like a covered call ETF. There's maybe a dozen S&P 500 covered call ETFs on the US market, a dozen Nasdaq, there's Russell ones now. So they all invest in the S&P, they all invest in Nasdaq, but they all have a different covered call strategy. So it's just a matter of choosing which one you like the best, but definitely one of those. I feel like it's just the easiest, simplest way to invest where you could just never go wrong. Index-based covered call ETF. Hopefully, we got some leverage ones that will start coming out in the US. I feel like you guys are a little bit behind on the income space. It's exploding right now. There's a million, like there's a Defiance, there's Yield Max. Invesco joined the game now. Invesco has their own Nasdaq and S&P. There's Neos, of course. There's Global X. They were kind of like the original. I mean, who am I missing? There's so many of them. Goldman Sachs is there, of course. J.P. Morgan. They have the two biggest ones, JEPI and JEPQ. So it would be one of those. That's where I just feel like you just can't go wrong. Index based, whether it's income or growth. If it's growth, go for a VOO or an IVV, or a Nasdaq side, it would be QQQ or QQQM, which has a smaller fee, QQQM. Definitely not a single stock. It's just too dangerous for me. I don't want to deal with that. You're going to be checking your phone every day, looking at it, maybe following the quarterly reports. Add up all that time you're spending, it's not worth it. Just invest in the market. Can't go wrong.
So investors, it's yours for the pickings there. Join Adriano on passive income investing to learn a whole heck of a lot about how exactly he did it, but most importantly, how you can also do it as well. A lot of insights on his channel. I'm certainly learning a lot now that I've discovered it. So, Adriano, I want to thank you for joining me on Masters of the Market. And for all the investors out there, until next time,
A
we'll
pleasure.
catch you in the next one.